Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Concrete Pumping Holdings, Inc. Annual Report. Concrete Pumping Holdings, Inc. Market capitalization of $0 billion is materially smaller than most of its industry peers of roughly $5 billion. Concrete Pumping Holdings, Inc. trades at a higher price-to-earnings ratio of 46 times and a lower price-to-book ratio of 1.43 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 64% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. Concrete Pumping Holdings, Inc. offers a diverse range of services to various industries. The company's primary business includes concrete pumping services provided under the Brundage-Bone and Capital Pumping brands. These services cater to general contractors and concrete finishing companies in commercial, infrastructure, and residential sectors. In addition to concrete pumping, the company also provides industrial cleanup and containment services primarily to customers in the construction industry through its Ecopan brand. This service is a testament to the company's commitment to providing comprehensive solutions for its clients' needs. The company also engages in equipment leasing and rental services, offering concrete pumping equipment, pans, and containers to its clients. With a large fleet of over 900 boom pumps, 90 placing booms, 20 telebelts, 300 stationary pumps, and 130 waste management trucks, Concrete Pumping Holdings, Inc. is well equipped to meet the demands of its customers. Overall, the company's services are designed to cater to various aspects of construction and infrastructure development, making it a one-stop shop for clients seeking comprehensive solutions. The stock price of Concrete Pumping Holdings, Inc. has remained relatively stable over the past year, with no significant changes exceeding a 3.62% fluctuation. This stability can be attributed to several factors. One key reason is that the company's financial reports have met or exceeded analyst expectations, as seen in its fourth quarter and fiscal year 2025 results. Despite a decrease in revenue and net income compared to the previous year, the modest after-hours increase of 2% suggests that investors are cautiously optimistic about the company's future prospects. Another factor contributing to the stability is the company's strategic acquisitions and expansions. The acquisition of CGA Concrete Pumping Limited in Ireland by Brundage-Bone subsidiary has expanded its international presence, which may have been seen as a positive development by investors, but did not trigger significant stock price changes. Additionally, the company's efforts to manage its finances through debt offerings, such as the senior secured second lien notes offering, may also be contributing to the stability. The announcement of a special cash dividend of $1 per share in January 2025 further suggests that investors are receiving returns on their investment, which could be stabilizing the stock price. Overall, while there have been several news events concerning Concrete Pumping Holdings, Inc. over the past year, none of them have triggered significant stock price changes exceeding a 3.62% fluctuation. This stability may indicate that investors are confident in the company's long-term prospects and are not reacting strongly to short-term news events. The primary drivers of revenue growth for the company can be attributed to several key factors. One major driver is expansion through strategic acquisitions, which has enabled the company to increase its market share in the US and UK. Additionally, growing demand for commercial and infrastructure construction projects with higher price points has contributed significantly to revenue growth. The integration of acquired operations and realization of revenue, profit, and cost-saving synergies from these acquisitions have also played a crucial role. Furthermore, cross-selling Ecopan services to existing concrete pumping customers has been another significant driver of revenue growth. The company's focus on organic volume growth in U.S. concrete waste management services and pricing improvements in this segment have also contributed to its revenue growth. Moreover, the expansion into new markets through acquisitions and integrations has provided a boost to the company's revenue. On the other hand, several factors pose risks to revenue decline. The economic downturn affecting the construction industry is a major concern, as it can lead to decreased demand for concrete pumping and waste management services. Changes in regulations or laws impacting concrete waste management also pose a risk to revenue growth. Competition from alternative services and a decrease in commercial and residential construction demand due to high interest rates and economic uncertainty are other factors that could negatively impact the company's revenue. The net income of the company experienced a decline from $425.9 million in 2024 to $392.9 million in 2025, resulting in a decrease of $33 million. This downturn is primarily attributed to non-cash expenses and changes in working capital rather than a reduction in revenue or operating performance. Several factors contributed to this change in net income. The global economic slowdown, characterized by inflation and high interest rates, had a negative impact on the company's operations. Additionally, cost increases were not fully passed on to customers, resulting in decreased gross margins. Furthermore, increased liability claims and potential uninsured losses also played a role. The profit margins of the company also underwent changes during this period. The gross margin declined from 38.9% to 38.5%, indicating a slight decrease in profitability. Operating profit margins were not explicitly stated, but are implied to have been affected by the changes in interest expense and tax rates, which increased significantly. The company's financial performance indicates a strong ability to generate cash from its core operations. As shown on page 29, the cash generated from operations totals $359.5 million, demonstrating a significant amount of available liquidity. Furthermore, the net cash provided by operating activities is substantial, with figures of $64.3 million in 2025 and $86.9 million in 2024, page 31. This indicates that the company's core business is generating sufficient cash to meet its financial obligations. The company's ability to generate positive operating cash flow is also explicitly stated on page 35, underscoring its financial stability and resilience. Overall, these indicators suggest that the company is well-positioned to manage its finances effectively and continue to grow its operations. The company's debt level and interest expenses have undergone significant changes over the past year. On page 17, the debt level increased by $109.9 million from $315.1 million to $425 million. This increase is attributed to refinancing of senior notes and repayment of outstanding indebtedness on page 27. Furthermore, long-term debt has seen a substantial rise from 2024 to 2025 due to the issuance of new senior secured second lien notes. Interest expenses have also experienced significant changes. On page 17, interest rate changes after September 6, 2024, led to a notable increase in interest expenses. Additionally, on page 27, interest expenses rose by $5.7 million, 22% increase, from $25.9 million to $31.6 million. The U.S. concrete waste management services and U.S. concrete pumping segments also saw increases of $2.9 million and $2.7 million, respectively. In contrast, some pages do not indicate significant changes in debt level or interest expenses. These include page 16, where no significant change is mentioned, as well as pages 35, 36, 42, and 64, which provide no information on changes in interest expenses. The performance of various segments and regions in the industry has been mixed, with some showing significant growth while others have struggled. One area that performed well is the U.S. concrete waste management services, which saw a notable increase of 6.4%. This suggests that companies are finding innovative ways to manage waste effectively, leading to improved efficiency and profitability. On the other hand, certain regions have underperformed. The U.S. concrete pumping segment experienced a decline of 10.5%, indicating potential issues with demand or operational challenges. Similarly, the U.K. Operations saw a significant drop of 10.9%. These results may be attributed to various factors such as market conditions, competition, or regulatory changes. In contrast, the western states of California, Oregon, and Washington have shown resilience in their multi-employer pension plans, with all being green, greater than 80% funded, as of October 31, 2025. This is a positive indicator for these regions, suggesting that they are better equipped to manage their financial obligations. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. In fact, the company has paid dividends on multiple occasions, with one notable instance being in 2023 when it distributed $1 per share, totaling $53.1 million. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. Specifically, in 2023, the company repurchased 274,401 shares for a total of $1.8 million. This demonstrates the company's commitment to creating value for its shareholders and reflects positively on its financial management practices. There are valid concerns about supply chain disruption and inventory buildup that could impact our business. One major concern is the potential insolvency or financial difficulties of key suppliers, which could lead to termination of relationships or interruption of access to essential equipment. Additionally, there are risks associated with increased costs of new equipment due to rising material costs, regulatory requirements, and other factors beyond our control. Furthermore, existing equipment may become obsolete due to technological advancements or changing customer demands, leading to additional expenses. Our reliance on international suppliers for certain key operational equipment exposes us to the risk of cost increases or supply constraints. The threat of significant tariffs on imported goods could also have a direct and indirect material adverse effect on our business. To mitigate these risks, we are building up inventory levels, which is expected to increase by $1.2 million in 2025. This inventory consists primarily of replacement parts for concrete pumping equipment and is regularly evaluated for obsolete and slow-moving items. That concludes the financial summary for Concrete Pumping Holdings, Inc. Feel free to comment below, and I will be happy to answer them when possible.